Hello, everybody, and welcome back. Today, my guest is David Choa. David is the head of Greater China Equities at BNP Paribas Asset Management. Welcome, David.
Thank you, Thomas. Thanks for having me today. It's my pleasure here.
It's my pleasure. David, today we want to talk about Chinese technology stock markets. And we have seen during COVID-19 crisis, Chinese stocks have been quite stable in comparison to other stock markets. And especially Chinese internet stocks have performed very well. But what do you think about current valuation levels of Chinese internet stocks?
Thank you, Thomas, for the question. Actually, when we talk about Chinese internet stocks, there are many subsectors. So some subsectors like the giants, Alibaba, Tencent, e-commerce players, online gaming, those companies has been doing relatively well. But some other sectors like travel, like the macro-related sectors, like the online properties, online auto, those has not been doing quite well. So all in all, is the variation has been quite okay. Even when we look at the U.S. comparables, the Chinese internet company is not extraordinarily expensive at the moment.
So especially Alibaba and Tencent, if you have a closer look into most of the portfolios of active managed mutual funds, they have a very dominant position there. Is it due to some index considerations, or is it because you really like their business model?
I think it's a combination of all these. First of all, technology has become a very important sector. If we look at the US, it has been 10% of the market cap, and now it's like 30% of the market cap. So basically, international investors looking at the same angle at China right now, and they look at the companies that they can understand. Alibaba and Tencent are the first batch of the first generation of such giants coming out from China, and they do have business model that is resembled similar to those in the US. So this is something they could understand and they want to get in. So this is the reason why.
So currently we are experiencing what some call technological Cold War between the US and China. What does this technological decoupling mean for the outlook of Chinese technology stocks?
Very good question. It's indeed happening. But we need to take a step back. Both US and China are very big. It's very hard for them to really decouple from each other. But now when we look at the situation, we also need to separate from upstream and downstream when we talk about the tech sectors in China. So these days, we have to understand that for those companies, it's no longer a question of whether they will move out some of the capacity out of China. I think it becomes a question of when and how much. From what we see, 15-20% is to start with. But we have to understand that at the end of the day, what dictates whether something is produced in China or not is really the productivity. Does it still make sense for China, companies to make the goods in China? Those are the implication for the upstream company. And to that point, Chinese companies still have advantages. For example, there are very mature supply chain in China. So you may go to other countries, but then if you don't like this vendor, it's hard for you to find a replacement. But in China, there are many options, and then the supply chain, they are very mature, which means that they can produce a lot of things in high volume for the international giants in a short period of time. In the same time, they are willing to have the flexibility to accommodate to the customization. So for the upstream, I think the question is more complicated. The risk is really on the downstream. For the downstream, I think the risk is really on some subsegment on companies that rely a lot on the US demand, or actually some of the critical components has to be sourced from the US. So for those subsectors of company, there will be certain risks. And we can see from the Tencent and TikTok incidents, they're really low safe pace. Every name could come into the pace when we go into this US geopolitical tension.
For many Chinese technology stock, their exchange career started in the US. but due to the Cold War and the trade conflict, U.S. stock market is becoming increasingly unattractive for Chinese technology stocks. So what are the consequences and what does this mean for Chinese technology stocks and Chinese capital markets in the near-term future?
I think right now the pressure is really for some of these companies listed in the US, the US ADRs. But there's no short way that really the US could kick them out, because even for the US, there are lots of interest in this company itself, financially interest. So the pressure is always to be there. But for those Chinese stocks that is listed in the US, the risk is whether they could release somewhere else. Nowadays, we see the Asia domestic market and then the Hong Kong market are more accommodative to a lot of these technology companies. And once they got released in this market, whether through a second listing, I think basically they already buy the insurance. It becomes less important of what US do to these companies. And to the Chinese government, also they have a huge incentive to introduce these technology companies back to the domestic market, because they want to showcase that now the index is no longer about the old economies, it's also about the new economies. And also that it will be a positive sign for the entrepreneurs who want to raise capital in the market as well.
So there had been a lot of rumors and discussion about the new China Standards 2035 plan in the past couple of days. So can you explain what exactly does it mean and what is behind it?
Certainly. Before I answer that, we need to take a step back and see why China see innovation is so important to the country. First of all, technology nowadays is just like the energy in the early 1950 or 60. It is the most important factor that dictate the fate of nations. It's very important. And China understands that, and that's why, but in the same time, a lot of the critical technology components still sourced from US. They only can make maybe 5-10% of it. So they need to reduce the reliance, the dependency from the US. And secondly, China actually also has a very large traditional industrial sector. And with those sectors, you really need the technology to help them to improve their productivities, because the low hanging fruit of volume growth is almost gone. They need to really to raise their productivities to maintain competitive in the market. And thirdly, actually, what happened now is innovation is happening in a very fast pace. From the mainframe computer to 1970, it took maybe another 20 years to have PC. But then from PC to handset, it may take only 10 to 15 years. And then less than 10 years to have smartphone. And now we are just seeing the wearables and the IoT device. So innovation is happening at a very fast pace. That means it's good for the newcomers like China, because they really have a chance to disrupt the market and surpass even the incumbents. That's the reason why it's so important. So with the 2035, we don't know what that's going to be in the plan, but we can imagine that there were certain areas of focus for the Chinese government. It's going to be the things that will to be critical for the future. There will be fast mobile internet, fast network. It will be chips. It will be local semiconductor design. It will be anything about AI, anything about AR, VR, and also anything about healthcare, because China has a huge aging population, but then they don't have the necessary resources to handle all those. So with better technology, they can handle the aging population better. But more than those quick areas of focus, another layer of thinking is really helping China to connect to the rest of the world. It's no longer about have or have not. What China wants these days is to have the standard, have a say of the standard in the international stage. Because a lot of the things of this is about ecosystem. It's not only about the competition of products, it's about the competition of ecosystem. With the ecosystem in place, you have a longer runway for growth, such as the chip design that we have seen in the and also on the cloud server ecosystem. Whenever you set up some ecosystem like the 4G, 5G, you have a long runway. And that's why it's not only about the the new buzzword between those cloud computing or the AI is also about setting the standard for the future.
So there's a huge IPO upcoming in China, and financial. They are planning their exchange listing, and it will be one of the largest tech IPOs we have ever seen so far, with a volume of around about 200 billion US dollar. So what can we expect from Ant Financial?
It basically is a milestone. It's something like the index in Hong Kong and China is changing. And this is another milestone of proving that it's like the index is no longer about the old economics company like the financials or the energy. It's about technology, innovation, healthcare companies. And for that to happen, actually, it also brings on additional positive effect to the local economy because it really shows that the market here is mature enough to evaluate these technology giants, and also it's also a signal to the entrepreneurs in the China market that they have a lot of venues to raise the capital, maybe not only in the US, but then also in China and Hong Kong these days. So basically, it creates a cycle of ecosystem for the tech scene to be further developed in China.
This was David Choa from BNP Paribas Asset Management. Thank you very much, David, for being with us today and sharing your views.
Thank you, Thomas. It's my pleasure.